Ladies and gentlemen, welcome back to the channel. We have an epic day for markets coming tomorrow. I will share with you all of the catalysts, the expectations for them, including earnings, retail sales, initial jobless claims, and much more. Today was actually the lowest volume day for the S&P that we have had in many months, and I think people are just waiting for tomorrow to make some bigger moves. We also had Fundstrat today. This is Tom Lee, Mark Newton, the gang that tends to be very bullish and positive, that just came out with a rare correction warning, saying that a correction is likely coming soon by mid-November. I will share those latest details with you as well. And of course, we will talk a little bit of Tesla stock. We will look at the chart specifically, where Tesla needs to hold and what could upside resistance at this point be for Tesla. But first, before we go ahead and get into all of that information, the only thing I ask you to do, and I don't ask all too often, is to hit that like button and subscribe to the channel. Help push this video out to as many people as possible, because I do think tomorrow is really going to help solidify either that soft landing or a not so soft landing. And I do think tomorrow you could see quite a big move in markets. When markets, they are only expecting about a 0.5% move up or down. I think it could be much larger than that if we are surprised. First up, Fundstrat's Mark Newton, Chief of Technical Strategy, says this on X. He says the road for U.S. equities grows trickier into mid-November. QQQ is shown below, very well could be peaking out as of today, Tuesday, October 15th, as I suspect a pullback to test 475 to 477 initially. Then after a bounce, a possible move down to 461 looks likely, with a maximum decline of 452. And just in case you guys want to know what that would look like on a percentage basis from today's level, a move down to the 475 area would be about a 3% decline from here. A move to 461 would be about a 6% decline, and a move down to 450 would be an over 8% decline. So they're really calling for anywhere between 3 and 8% downside, which is a very rare call if you know of Fundstrat's work. You may know of Tom Lee, and that's not a call you get all the time. They tend to be very positive. And when they do make these short-term calls, they tend to be pretty accurate. Now, the previous 2 trading days, you had an SPX bearish engulfing pattern, and now today you are being followed by a positive day for markets. Now, this chart just shows you throughout 2024, this instance that we have had of a bearish engulfing pattern and then upside the next day, and it's pretty much always led to a pullback in some, way or another. Sometimes a large pullback, sometimes not as large, but they do tend to lead to pullbacks, which this bearish engulfing pattern is when you hit a high on the S&P or whatever stock you're looking at, and then the next day you have a red candle that goes below that previous high. And that's exactly what you had. And now today you were green. It doesn't tend to have a very high positivity rate going ahead over the next couple of weeks. Good news is, if you are a Tesla stock investor, Jim Cramer recommends avoiding Tesla after the robotaxi event, which could be very bullish because people tend to inverse Cramer. Oh, and wait, Tesla stock was up almost 1% today. Yeah, no correlation there whatsoever. Kidding, clearly, Tesla stock is probably now going to move higher. And if it does, you can blame Jim Cramer. Furthermore, tomorrow morning, you're going to get some important earnings, specifically TSMC. Now, ASML is like the bottom of the food chain in regards to semiconductors and AI. It's like this, it starts with ASML. They're the ones that make the machines that develop semiconductors. So like TSMC buys the machines from ASML. So TSMC is clearly buying less machines from ASML. Does that mean that TSMC earnings are not as good? Or does that mean they just don't need as many machines now because they've bought a bunch of them? I think that's going to be the real question that is answered from TSMC. I don't think TSMC is going to give us a lot of insight to specifically what NVIDIA is doing, just because of how big a company NVIDIA is. But we will get some insight to the health of the AI trade, the semiconductor trade from TSMC tomorrow morning, in which we've only got just really bad news from ASML. It's possible that TSMC actually gives us good news, and they have favorable things to say about NVIDIA and the companies that TSMC is making chips for. And I do think ASML earnings lowered the bar for TSMC, kind of lowered the bar for NVIDIA and some other, AI stocks as well, but not completely. Expectations are still very high for TSMC and really the rest of big tech. Now, tomorrow in after hours, you will get earnings from Netflix. Now, Netflix is seen as one of your Mag 7, okay? Now, what's actually interesting about this quarter is we are not expecting any earnings growth, like 0% earnings growth, from the 493 other stocks in the S&P 500. Only your Mag 7 are expected to give us earnings growth. If Netflix does bad for whatever reason, which it doesn't look like it will, you've had a lot of upgrades on Netflix heading into the quarter, then the worry will build around the rest of big tech. And again, I'm really not too worried about Netflix. I could be more worried about Microsoft and Apple and maybe even Google for that matter. But if Netflix does disappoint, then that's going to be a problem heading into next week when we get more of your big tech names. So I do expect with Netflix earnings, you will get a sympathy reaction from the rest of big tech, which could move the markets actually quite a bit. Now, as long as earnings do not shock us in a bad way or shock us in a good way, you are likely going to pay more attention to the economic data coming out tomorrow. Now, just to start it off as far as the timeline, tomorrow morning, 8:15 in the morning, you're going to get the ECB interest rate decision. They're expected to cut rates tomorrow. They will likely do that. I don't know how much of an impact that'll have on our markets, if it'll have any. I doubt it, but it's always possible. Now, 8:30 in the morning tomorrow, you will get retail sales month over month. You are expecting 0.3%. Last month was positive 0.1%. So you are expecting retail sales are actually going to pick up from September, from basically August to September. Now, I don't see that happening. I don't see the preliminary data that suggests that. We've actually gotten data out recently that suggests personal spending, retail sales, personal spending, kind of the same thing, have fallen off a cliff in the last 2 months. So you could actually be in for a much weaker number than what we're expecting here tomorrow morning. And if we do get a weaker number, Wall Street is not going to like that. It's going to raise a lot of concerns about the consumer and concerns about that recession and or hard landing. Now, initial jobless claims tomorrow morning could be the most important thing to be watching for. Specifically, how did the hurricane affect initial jobless claims last week? Is it just kind of a rise from the hurricane states, or is it a rise in other areas? Well, you can actually break this data down per county, per state, so you can kind of see, like, how bad is it? Is it really bad? Is it not as bad? It might take a little bit of time to actually digest, but we are expecting 258,000 initial jobless claims, as high as 269,000 tomorrow. Now, last week, it was partially due to the hurricane. There was a rise in North Carolina, in Florida, right? In Georgia even a little bit. But the biggest rise happened in California, Michigan, it happened in other states. So you couldn't just, throw away last week's initial jobless claims. And that's why markets actually sold off when initial jobless claims came out last week. Now, if you come in around expectations, I don't think that's going to be seen as too bad. But if you come in higher, then you have a problem. If you come in 265,000, that's going to be an issue. Let's say theoretically you come in at 300,000, then you have a really bad day on our hands. Then you likely get a lot of selling pressure in markets. People will freak out over a number like that. Because if you look at initial jobless claims, the number that we got last week was the highest you had seen since mid 2023, and barely. So the highest level we hit in 2023 was 261,000. We were at 258,000 last week. If you come in at 265,000, that is now a 2-year high. That's higher than what we were seeing even in 2022, right? January, February, June, July. We were only like 229,000, 220,000, 200,000 initial jobless claims. That's part of the reason why the markets were not declared in a recession, right? Even in 2022 when the markets got destroyed. It's because initial jobless claims didn't spike, because there wasn't really layoffs. Well, if you see another big spike tomorrow, markets are going to be in a world of trouble, a world of trouble, okay? And I don't know what the number is going to be, clearly, but there is a chance that it comes in really high tomorrow, mixed with the hurricane and maybe more weakness in California and Michigan and other states. And honestly, if we are going to get an election correction, you probably have to see it from the economic data tomorrow, at least the start of that, because this earnings season, the bar has been lowered so much. It's going to be pretty easy for companies to actually beat on earnings. Now, they're going to be beating it at lower levels, which you could make an argument with. That's still not great, but it's going to be pretty easy for them to beat earnings because the estimates are so low. I think the economic data is the area in which is a little more concerning right now. What I mean by companies are going to be able to easily beat earnings, because the earnings revisions to the downside have been the largest we've seen since 2022. Okay. Really over the past 4 weeks or so, earnings estimates have been getting just destroyed to the downside. For this quarter, for next quarter, and for 2025. 2025 is a bigger issue, especially if earnings don't come in that great or guidance is not that great. Then your expectations for EPS for next year could also come down, and that would put the markets at an even higher valuation than we think they're at. If you just wanted to visualize this, if you're looking at 2025 earnings estimates, EPS estimates, that is this blue line here. They have been falling for weeks now. This is the more concerning spot, I guess. 2024 estimates have really been falling ever since June. This is pretty typical, but it's been accelerating in the last couple of weeks. Really, the last 8 weeks or so, you've seen a pretty dramatic decline in adjusted earnings for this year. At the same time, we have the start of earnings season. We have what could be bad economic data tomorrow morning. The equity put to call ratio fell to the lowest you have seen since July of 2023. Before that, it was the lowest since March of 2022 at 0.44. So there's just not a lot of risk out there. There's not a lot of perceived risk, that is. And people are not really buying puts right now, which, if we do get bad economic data, that's going to slap people across the face. And that's why I do think right now you are vulnerable for a pretty rapid, 3 to 5% decline, just because expectations are we're guaranteed going to have a soft landing. Earnings are going to come in great. The Fed's going to be able to cut rates multiple times over the next 12 months because inflation continues to fall. Like, we're expecting the best case scenario. Anything that derails that or questions that is going to be met with some pretty fierce selling pressure. Like, imagine if initial jobless claims come in 310,000 tomorrow. Wall Street is not positioned for that. There's really no downside protection out there. It's very rare to have downside protection right now. And stocks are going to fall a lot. And then everyone's going to go out and try to short some things to protect themselves for the downside. And that's where you could get a pretty rapid correction going, especially right before the election. Today was also the lowest volume day aside for July 9th of this year for the SPY, with only 30.5 million shares on the SPY that actually traded hands. So there's just not a lot going on right now. And I think People are really just waiting for tomorrow to at least get more information and to be able to make a better judgment call. And the last time volume was this low, the S&P did continue to go up for a period in time. At least before that, you had low volume. July 9th, you went up 1, 2, 3, 4, 5 more days. And then you did end up getting what was almost, I believe, a 10% correction. About a 9.8% correction, close enough. So, I mean, typically when you're getting this low volume just melt up, when you're getting this bit of a short squeeze in markets, and it's really not for the right reasons, earnings estimates falling, right? That's not the right reason if markets are going higher. Markets should go lower when earnings estimates fall. When people are just so complacent and assuming a soft landing, assuming things are going to be great, whether they are or not, you shouldn't assume that at this stage. It's far too early. Then you're vulnerable to get pretty sharp corrections. Now, I know a lot of this was the Japanese yen carry trade blowing up, but still, same point arises. We would have likely went through a correction either way. Now, I do think the read through for Tesla is quite simple as well. If markets do go through some kind of correction or downside, Tesla stock's also going to sell off with it. Could sell off more, it could sell off less. It really depends why we are going through a correction or what happens. I think an earnings correction could look a little bit different than a, bad economy correction. Okay, because Tesla is a cyclical company. It has a very high dependence on interest rates. And for those reasons, there could be different outcomes here. But generally speaking, if markets fall, Tesla's going to fall. Now, right now, you really want to stay above about 212, 213. That is where these two lines are intersecting. The downtrending line of resistance going back to Tesla's all-time high, and the uptrending line that we have at least seen since April of 2024. That's the kind of the intersection here. As long as we can really stay above that line, and more specifically, even this downtrending line of resistance, then the situation does not look too bad for Tesla. Problem is we're sitting at 221 and we're pretty close to that level. If we do see downside, you may break that level. Now, if we break that level, it's not the end of the world. If we get back above that level, that's going to be really what you want to be paying attention to. Tesla's 200-day moving average is sitting at about $201.82 per share. I think that is a level in which we'll find a lot of support at if we do start to break down. Now, if things go well, then Tesla stock is likely going to retest that 50-day moving average at 226 and make its way to the 20-day moving average up there at about $243 per share. That would be the level I would watch at least to the upside for some resistance. It looks like Tesla stock over the past 4 days has, at least the previous 3 days, has briefly, or for a period throughout the trading days, been up below this 100-day moving average and managed to close above it all 4 trading days. There is a lot of support coming in at this 100-day moving average. If this breaks, you could see a rapid fall in Tesla down to that 200-day moving average. That's what you tend to see if you hold support and it breaks. Tends to be pretty aggressive to the downside. But if Tesla does break out from here to the upside, then a break of that 50-day moving average could be coming in the not so distant future as well. So that's kind of my take on the situation. I think Tesla stock at $220 per share, if you're a longer term investor, is a great price. But I do think you can afford to be a little bit more patient here if you would like to, with all of the, economic risk, with all of the earnings risk, with the election risk, geopolitical risks that I don't think are priced into Tesla stock, right? Or, well, markets generally, but that would also get reflected in Tesla stock. And if that risk is not priced in and any of those risks do start to emerge, that's going to have a negative impact on Tesla. It's going to have a negative impact on the markets and could mean lower prices. So we'll see. I'm optimistic we will get a better buying opportunity here over the next couple of weeks. I hope we do, because I would love to go shopping and to buy more Tesla at even lower prices. What a gift that would be heading into the holiday season. With that said, let me know what you guys think about this information down below in the comment section. You guys have a safe and great rest of your day. I will see you in the next one.